Bank turmoil, meantime, is not helping consumers, to say the least. Our next guest, though, says pockets of strength do remain. I'm joined by John San Marco, who manages Neuberger Berman's Connected Consumer ETF. John, good to have you here. Broadly speaking, how are you thinking about consumers here? You simply have a split opinion here about, well, we still have excess savings, wage growth is pretty good, inflation has peaked. On the other side, you start to see some strains in the household balance sheet.
Yeah, thanks. Great to see you. I think you set that up well. But a lot of the good guys are getting less good. So we had this really flush consumer balance sheet the last couple of years, and those savings levels, the excess savings have largely depleted. Inflation is coming down, but it's still too hot for the consumer to feel particularly good, and you're seeing that in the consumer confidence data. And when you layer on top of that some of the bank-related headlines we've seen this week, that certainly doesn't help. I mean, we've seen it unnerve depositors, we've seen it unnerve capital markets, and certainly not going to have a good positive impact on the consumer's degree of confidence. And the next thing to look out for is whether that drives some credit tightness and difficulty accessing credit for the consumer. That's one more headache to potentially worry about.
And on top of all that, of course, you've had this shift towards spending on services over goods, which has pressured some of retail. I'd like to get to where you go in that environment in terms of stocks that you actually like. Dollar Tree is one. What's I guess, maybe the macro and micro story here?
Sure. Well, to your point on services, we think that wallet share shift is probably coming to its end. We're in more of a steady state environment as far as consumers spend between services and between goods. But to Dollar Tree, we think they're positioned perfectly for this environment. Our thesis there really starts with a new management team. This new team's already run the dollar store turnaround playbook with tremendous success at Dollar General a decade ago. And one of the first changes they made when they came in was they changed the pricing architecture at both the Family Dollar banner as well as the Dollar Tree banner they operate. And we're seeing in the data that we track, the business is responding quite well. New customers are coming in, better customers are coming in, they're behaving more loyally. So what we think we'll hear, they're going to have an investor day in June, and what we think we'll hear is how this translates to faster store growth in the years ahead and much higher margins over the years to come.
All right, and do want to get your take on Walmart here. I mean, is it just purely defensive and the move towards staples, or are there things happening at the company that are also interesting?
Yeah, they're certainly in the right place at the right time. So I think the question is fair. I also think they have some idiosyncratic self-help, which we're drawn to here. And that's really the way I sort of position it is they've operated at an extraordinarily high level the last couple quarters, and then they built so very little of that momentum into their 2023 guidance. So, we think one of two things must be true. Either that guidance and expectations are way too conservative, or the rest of retail perhaps is in really big trouble. Either way, both of those are scenarios where you want to own a big defensive name like Walmart. And what we're seeing in the data we track, again, very similar to Dollar Tree, they're bringing in a more affluent consumer who's putting together big baskets and really engaging with them in multiple channels. And we think all of these things, augur well for them continuing to take market share.